We'll start our discussion here on risk, talking about value at risk. Value risk, again, very heavily used in finance, especially with the big investment banks. We used it at UTSA quite extensively. Financial services companies use value at risk a lot. Other companies probably do as well. They may call it something different. Like at UTSA, we use value at risk, but we didn't call it value at risk. We call it probable maximum loss or something along those lines. But essentially what value at risk is just asking at some probability how much can you lose, and it's usually a really low probability. So you might have a 1% probability, so you say 1% of the time we expect to lose $1,000 or more, or $1 million more, or $1 billion or more. At USAA we used a 0.2% probability. That was our risk tolerance, 0.2%, and we could lose say $5 billion or more. So we're using parametric VAR. Parametric VAR is the easiest of the three. Remember, there's historical VAR, stochastic VAR, and we're going to use parametric VAR. By far the easiest because it's just this formula right here. Just have three numbers, or four numbers, well, three numbers to stick in order to calculate the fourth one. So the first thing you do is you have to pick a risk tolerance. The closer to zero you are, the lower your risk tolerance is, the less tolerant you are at risk. So like I said, at UTSA, our risk tolerance was 0.2%, essentially a 1 in 500 year event. So what's the worst thing that can happen 1 out of 500 years? So that was our goal. We're actually more conservative than that when I was there. It was actually, but that was the starting point. It was interesting at UTSA, my boss was involved in a project to figure out what UTSA's risk tolerance was and what its value at risk was. He was working on the project, and UTSA's board, the executive council, was at a planning conference, and the very first meeting of the planning conference, the CEO, Bob Harris, said, "What's the answer to our risk tolerance?" And no one knew the answer because my boss was still working on it. He had been given 5 or 6 months to work on it. And so Bob Harris canceled the planning conference. They all went back. It cost a lot of money because they had reserved all these hotel rooms, and they just canceled everything, went back, and Bob Harris says, "We can't answer this." They got back. My boss's boss's boss came back to my boss's boss, and said, "We need this answered this week." And so fortunate for me, my boss was out of town. He was the one supposed to be working on this. So the project, I told his boss, "Give it to me. I think I can figure it out." And it took me about 3 hours. I came up with a solution. I was really excited. It was really a pretty exciting day in my career. I remember the lady I worked with named Lori, and when the light bulb went off and I figured out, hey, this is how we could do it, I called Lori over. She got all excited. We went into the corporate treasurer's office. He got all excited. We went into his boss's office, and a couple weeks later, or a week later, we were in the CEO's office presenting that to UTSA. And it's interesting, Bob Harris, UTSA CEO, very mathematical person, brilliant guy. He's unfortunately passed away since then, but very mathematical. He had a lot of engineering and applied math in his background. So when we asked him, what risk tolerance do you want, essentially we're asking him, what probability do you want that UTSA will go insolvent? A lot of CEOs will say, well, 0. I don't want any risk, but you can't run a business at 0 probability. And it was interesting, his logic for how he came up with 0.2%, which is one of the scenarios I had ready to show to him. And so that became UTSA's value risk approach. And boy, it's still essentially there to this day, a little bit changed. But it's exciting. So when you talk to a firm and they talk about this, if you went to Goldman Sachs or Morgan Stanley, most of them, they already have it in place. It's been there for years. But I was just really lucky that when this question had to be answered at UTSA, I was there and my boss was out of town. So sometimes you get those lucky events. And I took the risk and told my boss's boss, hey, I think I can figure it out. And unfortunately, I was able to. If I couldn't, it would have been pretty embarrassing. He let me have a couple hours, even though we're under a huge time constraint. But firms actually do this in practice. So just then, a long story to let you know, I'm not making this stuff up. This isn't textbook. This isn't busy work. This is what firms do in practice. So you got to pick a risk tolerance. Your risk tolerance will probably be related to the ratings that your firm wants. So at the time, USAA was a AAA rated firm, so we had to choose a very low risk tolerance. For individuals, it's pretty subjective. I haven't seen any financial planners who do a good job of this. A lot of them use risk questionnaires. If you take my investment class, I'll talk about why I do not like risk questionnaires. I don't think they do a good job at all. In fact, I think they do more harm than good. But for most individuals, young individuals might use a risk tolerance as high as 5%. Most Americans are probably about 1%. And older American, especially someone near or in retirement, might use something as low as 0.1%. The key for individuals when they're planning for retirement is how much do they want in stocks. So, that's a big issue. There's a rule out there that you take 100 minus your age. So if you're 22 years old, they say you should put 78% in stocks. I don't agree with that approach. I don't think it works. I think it's a little too simplistic. I actually think 20-year-olds essentially have 100% of their investment in stocks. And just because there's so little invested, you have so little to lose, and you just let it ride and don't worry about the volatility, don't even look at it. But I do agree, as people get closer to 60 or 70 years old, they need to definitely be thinking higher risk tolerance and lower allocation to stocks. But that's the first question. On the homework, on the Excel application, I give you the risk tolerance, so you don't have to come up with that number, but I do want you to know that it's definitely an issue. The next thing you do is you run the VAR. You figure out what the value at risk is. And again, the value at risk, let's say if you have a 1% risk tolerance, then I like putting that in the answer. VAR at 1% is the mean minus the number of standard deviations times the standard deviation. I don't give you the number of standard deviations, I give you the risk tolerance. But there is a formula that I can give you, and I'll bring it into the notes here, and then we'll see it when we do the Excel application. There is a formula in Excel, norm.s.inv, and inside that you put your risk tolerance. And when you do that in Excel, so this is in Excel, so you'll need this for the Excel exercise, it will give you the number of standard deviations associated with that risk tolerance. So hopefully you remember this from your stats class. So the number of standard deviations is how many standard deviations do you want to be from the mean. If we're assuming a normal distribution, we do that a lot in finance. With a normal distribution, the number of standard deviations gives you a probability. So up here we talked about 2.33 standard deviations. That's a 1% risk tolerance. 1.65, it's not as far from the mean, so it's not as serious of a downside risk. That's only a 5% risk tolerance. So you'll use this formula. On the Excel applications, I give you the normal table. You can do that as well, but I'd actually encourage you, and the way I'm going to do it when I work the exercises, I'm going to actually use this formula. I'll probably do it in the next session. So when you calculate this VAR at 1%, that's the amount you expect to lose, or more. That or more is very important, 1% of the time. You want to compare your value at risk to your risk budget. On the Excel applications, I give you the risk budgets, and then you got to figure out if the firm is in good shape or bad shape. If the value at risk is less than the risk budget, then you don't have to do anything, or you can actually take more risk. If your value at risk is greater than your risk budget, then maybe you got to fire someone because they're not doing their job. Maybe you need to reduce risk somewhere. That's probably what you're going to do. Maybe you cheat and you say, well, let's fix the model. Our standard deviation, we gave you the wrong number. We gave you 12%, but it's really 10%. There are firms that do that. It's somewhat cheating. As we say, all models are wrong. Some are useful. So there's a lot of subjectivity in there in this. Who knows if that's really a 1 in 500 year event. I might show you a little later. We may not have time, but if you look at 2008 stock market and this year's stock market, we've had several days that were, according to normal distributions, absolutely impossible. They could not have happened. We've had some weeks where we've had 2 or 3 days where each one of those 2 or 3 days were, according to normal distribution, were impossible. And why is that? Well, it's because the stock market the returns on the stock market are not normally distributed. They're actually skewed to the downside. So, but it's close. And in normal markets, it works pretty well. But at extremes, when you really are most worried, that's when these normal statistics don't work. So it's possible that value at risk is understating your risk. But anyway, you have something to work with. It does control your risk. It does mitigate your risk somewhat, because if you're taking on too much risk over your budget, you're required to reduce the risk. The risk budget is something that a committee will come up with. Sometimes your risk budget is just whatever the net worth of the firm is. That's our risk budget. That's called risk of ruin analysis. So essentially, the firm says, "Hey, we don't want more than 1% chance of going insolvent. So we want to make sure we don't have any losses greater than at a 1% event. We don't want a loss that's greater than our net worth." For individuals, getting risk budgets is really tough to do. In my risk management class, I talk about my approach, which I think works really well for, especially for people near or in retirement. It's a hedging approach to make sure they don't lose so much that they can't support themselves. So the goal is that they invest and make good money and have a great retirement, but that we control the portfolio so it doesn't lose more than what's necessary, that make them have to, move out of the house, sell their house, move into a cardboard box on the street somewhere or whatever, and make sure that their worst case scenario is that they can survive comfortably. So let's work a few examples. So you have an Uncle Todd, and he wants to buy U.S. large cap stocks. So so they're in the U.S. There are large companies like Apple and Walmart or Intel, and it's a stock portfolio. And so your uncle wants to invest that for your inheritance. He says he has a risk tolerance of 1%. Well, maybe he doesn't say that. Maybe that's just what you use, because that's pretty average for a typical person. And he doesn't want to lose more than 20%. So he wants to know, can I put all my money in the U.S. stock market, in a U.S. stock market fund? If that fund is expected, if stocks are expected to make 8%, and they have a standard deviation of 15%. So their risk tolerance is 1%. Remember, risk tolerance of 1% associates with a 2.33 standard deviation event. Our risk budget is 20%. That's what he gave us. So a VAR at 1% is going to be 8%, which is the mean. Remember the formula. It's mean minus number of standard deviations times the standard deviation. So our mean was 8%. A number of standard deviations associated with a 1% risk tolerance is 2.33. And the standard deviation is 15. When you do that, you get negative 2695. We don't express VAR as a negative number, so I want you to be careful of this on the Excel application. You'll get a negative number, but I want you to state it in absolute terms. We just know a value at risk is a loss. So like at USA's value at risk might have been $4 billion. We don't say our value at risk is negative $4 billion. We just say it's $4 billion because we know it's a loss. So his VAR is 26%, but his budget is 20. So no, he cannot do that particular project because it's too risky. I'm going to skip the Mary one. It's a little bit of a bizarre example. Just for sake of time, we are running a little bit behind. And there's other examples that you can do. Let's try this one. So the key with this one is sometimes we use percents and sometimes we use dollars. So you got to be able to switch between the two. So your boss is interested in a new portfolio strategy. You run your analysis and you determine that it has a standard deviation of 8%, an expected return of 6%. Your boss has a risk budget now not in percents but in dollars, and the firm's risk tolerance is 1.3%. So 1.3%, if we put that into Excel, equal norm.s.inv and put 1013, it will tell us, you have to put a negative sign first, sorry, it will tell us that is a 2.23 standard deviation event. 2.23. And so you take the mean, 6%, minus 2.23, that equates to 1.3% risk tolerance. The standard deviation is 8%, you get 11.84. but their risk budget's $15,000. Well, the portfolio is $225,000. So you take your VAR times, and you take your portfolio in dollars times your VAR, and you get $26,640. That's well above their risk limits or their risk budget, so they can't do that. All right, so let's try the Excel applications. We'll come back to this. I'm probably going to have to shorten this some just because we're running out a little bit of time. If you can take my risk, I do recommend finance majors to take the risk management class. We cover a lot of stuff that's actually quite valuable to finance majors. So especially in interviews. All right, so we'll come back to that. Let's look at, I'm going to put it on pause and bring up the Excel applications. Let's look at the Excel applications real quickly, and then we'll come back to this. All right, so Excel application 9, there's only 3 problems, and they're fairly simple problems. I'll work number 1 and show you how this is set up, and then you'll need to work the other ones. So again, let's put the problem up here. So there's the problem. Let's see how much I can expand this out so you can read it. All right, so using the following information from Merkel Corporation, I named it after the Germany Prime Minister. She must have been in the news at the time I wrote this problem. Merkel discussed possible actions. So calculate the VAR. The discuss actions is pretty straightforward. They're right there in the notes. Just remember, all you got to do is repeat what's in the notes. What do you do up here in the notes? If your VAR is too high, you might fire your CFO, reduce your risk, maybe play around with the model some. If your VAR is below your risk budget, do nothing or take more risk. That's real simple. And so they have a portfolio. The portfolio value is $1.5 billion. That's the notional amount. You don't have to know what a notional amount is. We covered that in my risk management class and maybe in my investment class. My investment class as well. So if you take one of those classes, you'll get the notional amount. It's something good to look up. It's a fairly confusing term, to be sure, but it's an important term because you see it quoted a lot. It has a risk budget of $150 million. Your risk tolerance is 0.003, or if you want to be real careful, 0.3 and just put the percent sign after it. So 0.3%. And the return expected, we're using daily data. Since we're using daily data, the expected return on most portfolios on a daily basis is just 0. Any given day, 0 is your best guess. And then we'll do the standard deviation. And the standard deviation of this is 0.043%. Next thing we need to do is we need to know the number of standard deviations for a 0.3 event. And so again, we use that. It's equal minus norm.s.inv and go up to your risk tolerance. I think we just saw it in the previous, well, I don't know if we did 1.3. Remember we did 1.3 and that gave us 2.23. Here we're doing 0.3. So that's you don't have to round it, but do it 2 decimal places. All those other decimals are out there. All those other decimal places are out there, but it's okay not to have to round it. That's fine. And so now we're going to calculate our value at risk. So remember, value at risk. So let me put some formulas in there. So this is given, that's given, that's given. That's given. All four of these things are just given in the problem. And then we're going to use this function here to figure out the number of standard deviations. And now our value at risk is going to be the mean minus the number of standard deviations times the standard deviation. So here the mean is 0. And remember, we do it absolute values, so equal ABS for absolute value. And we do the mean of 0 minus 2.75, which is the number of standard deviations, times the standard deviation. When we get that, we get 11.82%. This is value at risk, and our standard deviation, our risk tolerance is 0.3%. So I like to put that in there. That's our value at risk, but you notice that's a percent, and our risk budget's in dollars. So we're going to do the value at risk in dollars next. Now, if the problem asks for it, and I can't remember all three of the problems if they're exactly the same or what, but sometimes your risk budget, if your risk budget was 10%, you can stop there because your value at risk is in percents. If your risk budget's in dollars, then you have to convert your value at risk into dollars. So you just take your value at risk times your portfolio value. And so what do? If your value at risk is greater than your risk budget, then you say something like over budget, need to reduce risk, fire CFO, and or adjust model. I don't like the last one. If you're not greater than, and you can say within budget, can do nothing or take on more risk. So it's very, very straightforward. I'll put that down here so you can see it. Oops, I didn't do that right. Let me do it again. Over budget, need to reduce risk, fire CFO, and or adjust your model. If we'd been under, then you would say you're within budget, can do nothing, or take on more risk. Let me fix that. That one thing I didn't quite get there. So that's the problem. So all you can do is just plug those numbers in there, and you've got your answer. And so your other ones, your risk budget's in dollars in the second one, your risk budget's in dollars in the third one. So it looks like they're all going to be exactly the same problems. So that's how you do the value at risk problem. Should be a straightforward problem. We work through the VAR problems. So what we'll do next session is we'll walk through what we do if we have to work in the idea of correlation. So I'll stop it there, and we'll be back in the next session. I'll keep it a little bit shorter. This session went on a little bit long.